It's very difficult today to find investments that are solely U.S. based. Most companies conduct international operations to some extent, and to have a diversified portfolio increasingly these days means you need to have some international components to that portfolio. So it would be really good to have investment standards that are global standards. Lots of companies have operations in multiple countries. Clients want to be assured that the information that they're receiving is complete and accurately presented. Companies in countries that have very minimal presentation standards that don't require a lot of their investment professionals with international standards means that they can be compared accurately with portfolios in countries that do have very well-developed standards. With global standards, that means clients are going to have more confidence in the performance numbers that are generated by companies throughout the world. As such, something called GIPS, Global Investment Performance Standards, have been developed. These were developed to meet a need for worldwide standards because of the increasing globalization of business, and it also provides a standard for calculating and reporting investment performance that can be understood and used globally. While many countries have standards, often their standards are developed for that particular country. These standards, the GIPS, Global Investment Performance Standards, were designed to provide standards for countries that didn't have any standards and to create a set of standards that have very broad applicability. The main parties concerned with these standards are investment management firms and their clients and their prospective clients. The Investment Performance Council, or IPC, was created in 1999. One of the jobs of the Investment Performance Council is to maintain and develop very high-quality investment performance standards. This council provides a structure for implementing the standards, and it encourages very wide participation in the standards. The GIPS standards, Global Investment Performance Standards, are designed to do things like allow investments to be fairly and accurately compared across countries. What these standards do is set a way of making the calculations so that if you see portfolio calculations on return in one country versus return in another country, you'll know that they've been calculated the same way and you're receiving a fair, accurate, and complete accounting. What these standards also do is allow for fair competition globally. That says that when you know there's a set of standards that everybody is adhering to, then you can be more assured that what you're seeing in one country's portfolios can truly be directly comparable to what you're seeing in another country's portfolios. What that is going to do is allow for greater confidence. If you have standards, and if you know that these standards are being followed, you will have more confidence in the data that you're seeing. Part of the vision of the standards is to encourage global industry-wide self-regulation. With these standards, what that means is you're going to be able to see performance results that can be easily compared among investment management firms, no matter what their geographical location. It's going to encourage communication between the investment professionals and their clients about how the investment firms have achieved their performance results and how to determine future investment strategies. Let's look at some of the characteristics of the Global Investment Performance Standards. The first thing is only firms can claim compliance, not individuals. Only a firm can say they have followed the standards. Individuals cannot. What the standards require a firm to do is to look at its portfolios and divide them into what are called composite portfolios. Composite portfolios are those that are grouped by either strategy or by objective. For example, you could have portfolios that are all high growth portfolios or value portfolios. And in a few minutes, I'll be talking very specifically about what needs to be done to ensure the creation of fair composite portfolios. The standards also specify exactly what calculation and presentation methods must be used. So again, you do have standardization in the presentation. The standards also mandate full disclosure. You've got to explain everything about how those numbers were reached. They also require fair reporting, that again, you're not unfairly grouping or unfairly bringing clients' portfolios in and out of the composite portfolio in order to make sure you've got an accurate picture of what's going on. The other requirement is that you make sure you use ex-ante criteria. In other words, you set your criteria before the fact, not after the fact. You can't look at how the portfolios performed afterwards and then say, let me group them this way. That makes things look better because of the way I have them grouped after the fact. You must make sure that you have grouped things together before the fact. The standards provide very specific guidelines that firms must follow in order to be compliant. You must have full disclosure and fair reporting as goals, as investment performance goals of the firm. These standards have to be used in presenting performance of assets that are managed for third parties. You also have to have compliance with the local laws, and in particular, when the local laws conflict with the standards, then you need to disclose that there is a conflict. Of course, again, local laws are going to come first in that country, but if they conflict, explain what that conflict is. The standards also have separate provisions for things like private equity and real estate that need to be applied very specifically to those asset classes. These standards are not set in stone. These standards are going to change over time as additional performance-related issues arise. And that's where that Investment Performance Council that I mentioned earlier comes in. The Investment Performance Council would like all countries to adopt the Global Investment Performance Standards. Compliance will provide a much more level playing field for all firms once that happens. A country that is going to adopt them needs a local sponsoring organization. The local sponsor helps ensure that the country's needs are taken into account in developing the standards. Countries are encouraged to translate the standards into whatever the local language is, but keep in mind that the English language version is the one that predominates. That's the one that will answer any questions if there are disputes. Standards are going to be evaluated every 5 years just to make sure that they remain current. Regulators should understand the benefit of voluntary compliance with these standards. That's a global best practice if everybody would voluntarily comply with the standards. False compliance claims should be sanctioned as fraudulent advertising. There also should be independent verification to make sure that what the firm claims really is true. Compliance with the Global Investment Performance Standards, along with local regulations, is encouraged, and any conflicts between local laws and the standards must be disclosed. I mentioned earlier that I'd go back and explain about composite portfolios. First of all, the portfolios that go into a composite, into a grouping of portfolios with the same strategy or same goals, first they have to be real portfolios, not models. In other words, it's a client's actual portfolio, not what you think you'd like to make a portfolio up of, an actual portfolio. They also must be fee-paying portfolios and discretionary portfolios. In other words, the investment manager must have the discretion or ability to add or subtract stocks or other securities as desired. If the client has rules, you must do this, you must not do that, then those portfolios should not be included in the composite portfolio. In order to be able to claim compliance with the GIPS standards, you must have at least 5 years of performance data, and 10 years of performance data is preferred. Let's look at what is the scope of the standards, particularly in relation to the definition of the firm, past performance, and compliance. First, let's look at what is the definition of the firm. As I said before, only firms can be in compliance, not individuals. Firms can only claim compliance if all of the departments within the firm are in compliance. A firm is defined as an investment company, a subsidiary, or a division of a firm which is presented to clients as a separate business unit. What this means is that a subsidiary can be compliant even if the parent company is not compliant.